All right, great to see you. This is Andrew Stotz, and we're going to spend some time together celebrating 2 years of the all-weather strategy, but also trying to answer questions that you may have about investing. So I'm glad to see everybody there, including my mom. I know she's watching. And all of my friends out there, I welcome you to ask any question as we get into this presentation. So are you ready to go? Do you have any questions about the markets? Well, I got 27 questions that got submitted to me that I've pulled together into this presentation. And so I'm going to go through this presentation and try to answer those questions as I go through it. And you can ask questions at any time, and as questions come in, I'll take them. So why don't we dig right into it and get started. So let me show my screen here, and I'll show you my presentation. So what I'm going to call this is the end of a 40-year inflation down cycle. And we're going to talk about inflation. But for those people that don't know me, I've been studying, teaching, working in finance as well as investing for 35 years. I'm also the host of my Worst Investment Ever podcast, where I've interviewed more than 360 people about their worst investment, which is really some of the best things that you want to learn. Also, I live with my mother in Bangkok. There we are on birthday time. So let's talk about the outline of what you're going to get today. First, you're going to understand where the all-weather strategy comes from. I know that some of you are already invested in the all-weather strategy, and others are considering to invest or just learn today. The second thing is we're going to cover the all-weather strategy methodology and objective. And I would say methodology is my key skill. We'll talk about the performance, and also I'm then going to dig into inflation, and I'm going to talk about the end of a 40-year down cycle. And then I'll talk about where would you position yourself. So don't miss this. Stay around for this section, inflation-based asset sector allocation. I've done some really deep research on this to try to understand where we should be allocated. And then the outlook for 2021, and finally Q&A. So let's get started. We're going to talk about where this comes from. So the origin of the all-weather strategy. Well, I want to tell you a story about my oldest sister, Kelly. And she studied finance like me. And there she is with 2 of her 3 adorable daughters. But we had a tragic loss. In 1998, near her 40th birthday, Kelly called me to tell me that her breast cancer had returned. It was a tough year, 1998, for the older people like myself on this call. You remember that 1998 was the year after the 97 bot crisis. The economy was in ruins. I rushed to Boston from Bangkok to see her, but she died a week later. It was a tragic loss for our family. She left behind 3 daughters, Sophie, Audrey, and Kristen. And that's me in the background, standing pretty tall. Later, her daughters, Audrey, Kristen, and Sophie, grew up. And Kristen, the oldest one, asked me, Uncle Andrew, since you're a finance guy, can you tell me how I could get rich in the stock market? Well, we sat down at the computer and I showed her how she could do it, which isn't that hard if you start investing when you're 18. Her eyes lit up. So after a year of that discussion, I wrote down a lot of ideas about creating a plan for her to invest in the stock market so that she could grow up to be a financially independent woman. I thought my sister would be proud that me as an uncle helped my nieces become financially independent. And so basically the problem was none of them were interested in the stock market. So I really had to make it as simple as possible. And ultimately I published this book. When Kristen turned 18, I went to see her in America. And I said if she could get through the study materials, I would give her $3,000 to set up an investment account. In America, she set up her investment account at Vanguard. That was easy enough. And then my other sister Sharon, had 2 daughters, Elsie and Hannah, and they graduated soon. And so eventually I ended up having to give all of my nieces $3,000. I didn't think about it at the beginning, but eventually it turned out that I had to spend a lot of money on that. But it was a great gift for them because it was a foundation for the all-weather strategy, which is built on this book, How to Start Building Your Wealth, Investing in the Stock Market. And it's really the same principles here that I'm talking about. But I learned something more from my nieces. to become successful in investing, they needed support, they needed their questions answered, and they even needed a nudge sometimes to contribute. And that's why I also created that book into an online course. And I have it in Thai also. So for my Thai viewers, feel free to go to this and you can learn about where AWS comes from. So in the next 24 hours, I'm going to give a 50% discount for my AWS subscribers and the people that are watching this. Just scan that code or else go to that bit.ly link. I think my business partner Alex will also put that in the chat. You can click on it and take advantage of that and you'll learn exactly where it came from. It's all 100% guarantee. If you're not satisfied, money back. So now that's the origin story of where AWS came from. Let's talk about the methodology. So I'm going to stop here for a moment and I'm going to ask you, it's time to ask your questions. I am here ready to answer any questions that come in. Now I have a lot that I'm going to cover, but I'm definitely going to try to cover all the questions that come in. So ask your questions now. Just type it in the chat. So I'm going to teach you a little bit about the way I do this. I call it FVMR methodology. So here's what somebody asked me. One of the questions is, how do you decide the percentage of equity fund and bond fund in each situation? Well, somebody drew that picture of me, so we put that in here. Basically, what you're going to see in this diagram is, I'm going to talk about FVMR. The first thing is fundamentals. Strong profitability shows that a company's managed well. So, and what we can see next is valuation. And valuation is related to price. And that is what investors do at the bottom. Wow, there's 500 people on here. Bring your questions. I can't wait to see them. Now, next thing we want to look at is momentum. You know, many years ago, I got really excited as a value investor about a really cheap stock. And so I thought, I'm going to buy this stock because it's super cheap. But the problem is it never moved. It stayed cheap. So the message that I want to get across is that we should be looking at momentum at least a bit. I don't mind waiting for a value stock for a bit, but momentum is key. And then there's risk. Of course, risk related to earnings, risk related to price. So those are the FVMR methodology that I find and follow, and it's quite structured. You'll see more. So what are your criteria for rebalancing? This is another question that you asked. And when is your next rebalancing? Well, we balance AWS 4 times a year. Why? Well, because we follow something called zero-based thinking. And that means that we set a 2-week period every quarter to consider the rebalancing of the portfolio. We start the exercise by imagining that our portfolio is 100% in cash. Why do we do that? This is the zero-based thinking. I highly recommend doing this. In fact, I had someone come to me and ask me for relationship advice. And I told them, don't ask me for relationship advice. I've never even been married. But I did have some thinking on it. And I told them, look, I'm going to just ask you one question. And that question will be my advice. And what was the question I asked them? I said, look, you now know the person that you're dating for now a year or 2 or 3. You didn't know them when you met. Now you know them. So my question to you is, if you weren't involved with them today and they came along to your life, would you start a relationship with them? That was my question. And the answer to that question is either got to be yes or no. If it's yes, I would, then you need to double down and build that relationship. If it's no, you need to get out. Why is this important? Well, have you read this book, Thinking Fast and Slow? Basically, Daniel Kahneman talked about how our minds hate walking away from what we've already invested in. It's called the sunk cost fallacy. And it's our tendency to follow through in action even when it no longer makes rational sense. Why? Because we've already invested in it. Now also, our brains have 2 different systems that he taught about. One is this fast system that's intuition, and it makes good enough snap judgments. The point is, and when the markets crash, this is what hits you. And then logic and reason comes in the slow system. And so the point is that there's new financial information coming in on a quarterly basis. So that's part of the reason why we do it quarterly. We also do it quarterly because we want to reduce turnover and reduce costs. Hopefully it leads to better decisions because we use that mentality of zero-based thinking. So the next question is, if something urgent happens, do you consider rebalancing more than once in a quarter? And I think these questions are good questions for anybody managing a portfolio to think about. I think my first advice is build your own structure and then build your rebalance period. Now, it has happened that we've broken that structure. During the heat of the 2020 market meltdown, we shifted our position in US bonds to Thai government bonds and told investors as quickly as we possibly could. And it's an example of something we did that was pretty extraordinary. Now, the threshold for this kind of thing needs to be very high. So we don't break that framework very often. I would say that's a lot of the reason why people like to invest in AWS and the other things that I do, because they know I'm going to take a careful look at it. I'm going to think fully. Now, also, we've looked at stop losses as a way of protecting risk. And this can work well with individual stocks, but we've found that it doesn't add value when you're looking at markets, regions, asset allocations. So unless there's fear of like a fund closing down or something, we're generally not going to do anything in between those 3 months. Our strategy is to make our best assessment of what is most attractive over the next 3 months and then let the strategy work. Okay, the point that I make with this slide is that if you keep pulling out plants and then replanting them, you're never going to get a garden. They're never going to be able to grow. So you got to let your stocks and let your investments grow. Let's talk about the objectives of the all-weather strategy. Somebody asked the question, how much should all AWS constitute of my total portfolio? Well, this is not investment advice. I'm just giving information. And so you're going to have to make that own conclusion. But let's think about 2 objectives. To capture the most of the global equity market's long-term growth, and to blend in other asset classes to protect against most of the equity downside. So in our view, AWS is a strategy that could constitute a pretty large portion of your long-term investment portfolio. Next question. This is a good one. Now, if we get any other questions that are coming in, I'll try to answer them as they come in. So make sure to submit any questions that you have. So this question was, will you create a new aggressive portfolio for a specific group of customers? Well, the answer to that is, remember, AWS is long-term, it's safe, and it's relatively low cost. It's also global. We're currently considering launching some more aggressive portfolios and strategies, but I'll update you more on that later. So I appreciate that question, and we're definitely looking at it, and I'll let you know as we go through that. Let's talk about investor goal. The goal is to provide those who follow the strategy with a way to reduce the time that they spend managing their money. That's really the key. We're trying to reduce your time. Now, the next question is, when should we invest in AWS? Any factors we should consider before investing? Well, since AWS is a long-term strategy where we're trying to move allocations based upon market conditions, it makes sense for you to invest anytime that suits you. Again, we're trying to do the work for you by allocating and doing the timing. All right, the next question we got is, can we invest in AWS anytime without looking at market timing? So again, we look at that market timing. It's not really necessary for you to do that market timing because that's what we're doing. So you may disagree with my allocations. You may say, oh, I don't want to be in Asia, I want to be in the US, or I want to be in tech, or whatever. That's fine, and that may determine your market timing. But generally, there's not a lot of reason for you to do timing and for me to do timing. It's either better that you do timing or have me do timing. The next question is one that I get often, is about lump sum investment and DCA, dollar cost averaging. Which one is better for AWS? Well, let's talk about dollar cost averaging for a moment, because I know it's a topic that everybody talks about. The point that I often make when you compare lump sum versus DCA is that most people earn their income on a monthly basis. They don't have a lump sum. If you have a lump sum, that's great for you. And now you've got a decision to make between DCA and lump sum. But for majority of people, you're contributing on a monthly basis, so you're going to do DCA. So I would say the answer to this question is that for most people, just do DCA. But if you have a lump sum and you've got to make some decisions, Well, the first part is that we're trying to do a set it and forget it long-term strategy. And basically, I would say leave the timing to us. But if you have a lump sum, I would consider putting the lump sum in a little by little, whether that's in AWS or your own portfolio. One of the biggest mistakes that I see investors do is they get excited about an investment opportunity. Remember, I've interviewed 360 people who told me their story of their worst investment ever. Maybe you have a story of your worst investment ever, and you could come on the podcast and tell me. But I've listened to all these stories, and I know that people get excited and they want to invest. But my challenge to you is take your time, invest step by step. So most people, right, if I would say most people really can only do DCA, and DCA will beat the market if you're trying to time the market, get in and out. DCA will beat that for sure. But a lump sum could beat DCA if the market was low and it was going up. Yeah, I'd rather put all my money in at the beginning and let it grow. But the point is that most people don't know. We don't know. Nobody knows. You know, when I was, tell you another story. When I was starting out as an analyst, it was 1993, and I got a job as an analyst. I worked for a broker called Tawanok Finance, which was Dynamic Eastern Finance. And I worked for that broker, and I listened to the analysts and the salespeople. They sounded so sure. They sounded so confident. And that's when I, really wondered, how do they feel so confident? Because I don't feel that confident. Of course, I was new and all that. But what I later learned was that a lot of times what we're doing is showing confidence, but the reality is we're all ultimately guessing about the future. And that really is why dollar cost averaging is usually better, because we're not that great at guessing about the future. Now, there's 3 drivers of the strategy for AWS. Now, this is a question I got related to it. Currently, there's so much negative news everywhere. What's the safest investment choice? Well, this strategy is global, it's long-term, and it's diversified. That's the AWS strategy. Now, let's just review the AWS strategy. We're now 2 years into it. And what is it? Well, the first thing to remember is it's global. The point is that most people in Thailand are going to have your Thai investments in the Thai stock market. You're going to be earning income from a job in Thailand. You're going to have property, a condo, a house. All of your investments are generally going to be in Thailand. This gives you something that is global. It's also long-term. My focus is definitely on the long-term. I'm trying to gain the upside in the equities across the world, but also reduce the downside. And it's diversified across 4 asset classes. All right, next one. Oh, this is kind of a funny one, so I decided to make some funny graphics for you. How many years do you plan to manage a portfolio with phenomena? I think you should make this full screen so we can see it. Let's see. Well, first of all, I've already committed 30 years of my life to the industry, and I'm ready for 30 more. That's pictures of me when I started out my career, and as I grew my career. There's me with a big beard. That's a funny one. And there's me recently. So the point is, I've been in this business for a long time. I love phenomena. What Bank and Jet, 2 guys that I know well, are doing, I think, is great. So I'm happy to be here, and I plan on being here for a long time. So what is your AWS estimated return for this year? Well, estimated return, truthfully, nobody knows. If you get somebody that says, well, I estimate that it's going to be a 10% return or a minus 2% return, people, ultimately, what I like to say is that we're all making it up. That's what we're doing in life anyways, right? We're just making it up as we go along. So nothing is certain. AWS is not a strategy that guarantees a return. It can go down and it can underperform. We aim for a 6% return per year, and so far we've gotten about 8.2 average annual return since inception. All right, let's look at performance here. So now I'm going to start you in at September of 2020. We were allocated 50% to equity and 30% to gold. And that did pretty well. Eventually, by December, we had allocated 85% to equity, and we had ridden some of that equity recovery that was going on. And then eventually in March, we've recently downgraded our equity exposure to 65%, and we've upgraded commodities. So we've been trying to ride some of the commodity. And part of what you're going to learn today is a little bit about inflation, and commodities is a big place to be for inflation. And that's the performance of AWS. We haven't captured all of the upside of just the world index, which is the red line. If you just only own the world, you would have been up more. But we've done okay over that time. And basically the key, this chart really is the key to the strategy. My goal is to help you sleep at night. I'm thinking about this strategy 24/7, and I sleep pretty well because I have structures. But what you can look from this chart, you can see that the red line, the red bar is the market, and the blue bar is AWS. And in the last 10 major market moves, AWS fell about half of what the market fell. So that's the objective with AWS. And if we look back at the line that I was showing you before, there's less volatility in the blue line. That's the AWS performance. So yeah, we're not the fastest growing, but we're steady. So what have you learned in this section? What are the key points and the bottom line? Well, in September to November, gold price began to fall, even though uncertainty remained in the market. Overall, the high allocation in gold in 2020 was positive for AWS performance. The relatively low equity allocation helped reducing the downside in the year, but it also dampened the return. I wish that I had had more exposure to equity and I wasn't so cautious, but I'd rather be cautious than be really in trouble. So what's the bottom line? The AWS aims to cushion the downside relative to equity-only strategy. Now comes the main event. I've worked on this research for a long time, and I'm excited to share it with you here. It's about inflation. So I investigated inflation over 120 years. And I'm going to go back to World War I. It was a defining moment for inflation. And here, I'm going to show you the chart of inflation. You're going to see this same chart over and over so you can get to know. But what you can see here is that the period from 1899 in the US, that's the data that I'm looking at here, is US inflation, to the end of World War I. End of World War I was the peak. So basically, 22 million people were killed, and the population was about 1.8 billion back then. There was then, after World War I, there was between 17 and 100 million deaths due to genocides and also the 1918 Spanish flu. All these soldiers were together, and then they all went back to their homes, and they had a pandemic just like we have today. And the point that I want you to see is that war causes demand pull inflation. It peaked at 20%. Now my chart doesn't go up to 20% because that's a moving average. That chart is a 5-year moving average, but it did peak at 20% in 1918. Now let's go into the roaring 20s, 1920s. And then that led to the Great Depression, one of the most iconic pictures here in the Great Depression. So now we're going to look at this period, post-World War I, and then till 1932. The roaring 20s saw rapid economic expansion and a stock market bubble. And then the 1929 stock market crash brought an end to that post-war bubble. And inflation bottomed at minus 11%, basically. And that was the bottom of the Great Depression in America. Now, let's move into the next phase of the history of inflation. And I want to show that we have pictures here of FDR, Franklin Delano Roosevelt, Stalin, Mao, and Hitler. These 4 figures shaped that period. So here we can see 1933 to 1939, the Great Depression recovery sets the groundwork for World War II. At that time, in 1939, there were the Nuremberg laws which removed German citizenship for Jews. Franklin Delano Roosevelt won a landslide second term, and Joseph Stalin began the Great Purge, killing millions of people. And the Communist Party of China completed the Long March led by Mao Zedong. And World War II started. And what you're going to see here is that every time we have a war, we have a peak in inflation. It was a global war, 80 million fatalities. The majority of them were civilians. Inflation peaked at 18% in 1946. That was at the peak of the war. And basically, I want to now move into the post-war period. America was great because every other country was destroyed. One of my mentors, Dr. W. Edwards Deming, who I studied with when I was a 23-year-old guy, said, in the decade after the war, meaning the Second World War, the rest of the world was devastated. North America was the only source of manufactured products that the rest of the world needed. Almost any system of management will do in a seller's market. Success in business in North America was confused with ability to manage. Dr. Deming was a tough guy, but the point he was making was that every country was devastated. And that basically, we went through a deflationary period that came out of World War II. From 1947 to 1961, the US war production shifted to the private sector. And the economy started to stabilize. You can see that inflation came down. And market forces balanced the supply and demand, because during a war, all the demand is being pulled into the war. Next, we move into the Vietnam War era. And here you can see US Marshals taking away protesters. And we ended up with inflation and death. So the Vietnam War era was from 1965 to 1970 or so. And I've picked that era because it reignited inflation. And more than 2 million Vietnamese dead and 58,000 Americans were dead. The point that I make here is that, again, we see that war is driving up inflation. Next, the Middle East becomes the war focus of the US for the next 40 years, even until now. So these next 40 years, in the beginning of them, we first had the oil shock, which brought inflation to 12% in 1974. Now you may say, well, Andrew, what's all this talk of the history of inflation? I want to know what inflation is going to be in the future. We're going to get there. First, we've got to make sure that we understand the past so that we can think about the future. So from late 1973 to early 1974, oil price had risen 300%. And this caused by an oil embargo against countries that supported Israel. So it was the beginning of a real disruption in the Middle East. And in fact, the oil crisis, which came next in 1979, had inflation up at 13%. It was caused by a drop in oil production after the Iranian Revolution. The global supply fell only 4%, but oil price rose by 2 times in a year. And it sparked the 1980 to 1988 Iran-Iraq war. So again, we see another peak in inflation driven by war. Now, I remember in the 70s waiting in line to get gas and petrol into our cars when I was with my mom and dad. Now, the next era is Paul Volcker breaking the back of inflation, and that set us up for this period of time that we're in. Jimmy Carter appointed Paul Volcker. Ronald Reagan appointed him for a second term. And oil price was at 128 in the mid-80s, and it fell to 18 by the end of 1998. It was nearly a 20-year oil price decline, and that's part of Volcker's making. So here you can see now that I drew a line to show that falling oil price is bringing down inflation. That falling oil price is a significant factor that set us up for the very low inflation that we have. So inflation was down to about 1.1%. Next came globalization. Hundreds of millions of low-cost workers hit the global labor market. And what you can see, I did a little study here, and basically I looked at these two charts. I went back to 1990, and then I went to today. And I asked the question, what would the wages of a typical American be in gold versus the typical Chinese? And at the bottom right, you'll see typical American workers could buy 51 ounces of gold with their wages in 1990, but only 30 by 2020. The typical Chinese worker could buy only 1 ounce of gold in 1990 with their wages, and now they can buy 9. But I think the defining feature in this chart is the fall in the wages in the US. Globalization, and particularly globalization of the labor market, really hit America hard. And to tell you another story, I grew up in Ohio. Anybody been to Ohio? You may have been to Cleveland, you may have been to Columbus. You know, I grew up in Ohio. I grew up just south of Cleveland in a little town called Hudson, Ohio. There was a lot of manufacturing in Ohio when I was growing up. But I left Ohio in about 1986 to move to California, and then I came to Thailand in 1992. The point is that the Ohio that exists now is nothing like what it was when I was there. There's no more serious manufacturing, and there's all kinds of struggles with drugs, with poverty, many different challenges that they're facing. And a huge portion of that came because of the fact that labor went to China. There's no way you can compete with like 100 million people coming into the labor force at a very low rate. So this also now, I've shown another line on this chart. The line on this chart that I've shown at the bottom is related to falling wages. So we can see, right, that wages were flat and oil price was subdued. So basically we had this period of extremely low wages. Now, next comes the Fed that tries to save the world. That's the Fed building right there. And now what we can see is from 2008 to the present, the US Fed and big government destroys and saves the US. Now that's kind of strange. I say destroys because they pushed interest rates so low that it caused a distortion in the markets. And that very low inflation rate basically caused people to borrow and stimulated the stock market and asset prices. That was something that caused the problem, and then they had to save the problem by bailing out the banks and bailing out the market. So we had the 2008 mortgage crisis, then we had the 2020 global economy shutdown. Fed lowers the rates to zero and keeps them there, and you have massive US government borrowing. But the government cannot allow interest rates to rise now because the cost of borrowing has to be low in order for the federal government to be able to borrow as much as it's borrowing. So that's the cap. They can't let interest rates go up too high or else they're in deep trouble. All right, let's review what you've learned. US inflation, I showed it to you in 10 eras. There's the progressive era, the post-World War I era. I showed you the Great Depression era, the World War II era, the post-World War II recovery when inflation came down, the Vietnam War era that pushed up inflation, the oil shock and the oil crisis that also pushed up inflation. And then I showed you about how Volcker started breaking the back of inflation. And then I showed you how globalization, the falling oil price, falling wages brought down inflation. And then I showed you how the US government intervened to try to save everything. All right, so what's the benefit of looking at the history of inflation? Well, the benefit is that now we can try to understand what's going to happen in the future. So let's look at this chart again that we've been looking at over the whole other section. I see three scenarios. Scenario number one is inflation could remain at similar levels. Commodities push up inflation, but maybe there's wage deflation. Like people can't, you're going to go to your boss and say, I want more money. Nobody in America is going to be able to do that right now. And in many companies, there's no way they could do that. Now, by keeping interest rates low, the Fed will be battling these deflationary pressures. And these deflationary pressures are strong, and accommodative policies support inflation. Now, let's look at the second scenario, that we're headed into deflation, where prices are going to be falling. This scenario would basically mean crowding out private sector, and that leads to less growth in the economy, meaning the government's spending tons of money. Companies aren't. The government's getting all the money and spending it. That's crowding out the private sector. Unchanged velocity. The turnover of money is very low right now. Maybe people just don't spend that much coming out of this crisis. Unemployment shows economy is far away from operating at full capacity. Now let's look at the final scenario, number three. Inflation is going to rise and continue to rise and be high. Well, it's exciting. We've got 600 people watching right now. I want to thank you for attending, and I hope we can get 600 questions. If you have a question, make sure to submit it. but feel free to submit your questions and I'll get to them. So, what is happening in this scenario? Well, war is a defining element of inflation. We've seen that over the history. And I suspect that Biden is likely to start the war machine. Already we're seeing some confrontation with China. We've recently seen Biden come after Russia, and we've seen a challenge to Russia. Russia has pulled back its representation in America. Also, the U.S.-China conflict means CPI is going to rise in America. Inflation is going to rise because trade is no longer cheap anymore. And oil price is rising. Supply has been hurt and demand is coming back. We do have a $1.9 trillion stimulus to spur inflation. Hopefully it gets in the economy. That's what they're trying to do. So I expect, this is my scenario, I expect rising inflation. I also expect that there's a possibility that we have a war coming up. It may not be a World War III, but I think that there's a lot of challenges going on against Russia and China right now. All right, so what are the key points and the bottom line? Inflation could remain at similar levels if the Fed and stimulus fail to create increases in prices. Next scenario is deflation, and it could happen if the velocity doesn't pick up, meaning people aren't buying and selling stuff, and growth in the economy slows, and unemployment remains high. Because remember, when unemployment's high, people can't get their price raises, their wage raises. So we think stimulus, the U.S.-China conflict and the U.S.-Russia conflict, and potential new wars is going to cause rising inflation. The market also is showing a rising inflation expectation because we can see that U.S. bond yields are rising, particularly the 10-year yields, which got almost up to 2%. That's coming from, down at 0.4 or wherever they were, a few months ago. So we are seeing that in the markets. What's the bottom line? Inflation moves in cycles. I expect rising inflation after a 40-year down cycle. All right, let's now talk about, okay, so now that you understand my scenario, the next question is, how do we invest? Now, your scenario may not be mine. Your scenario may be, no, Andrew, inflation is not going to rise. It's going to fall. That's fine. You pick your scenario, I'll pick my scenario. Hopefully, actually, I hope mine's not right because I don't want high inflation and I don't want war. So if you are saying that inflation is going to fall, then I'm happy if you are right. So the question that I got in relation to this was, how do you view inflation's impact on equity in second half of 21? How will commodities benefit from upcoming maybe inflation or stagflation? Stagflation is just when you have inflation but no growth in light of rising interest rates. All right, so I'm going to walk through an academic style study that I did, and I think we can get a lot from this. Here's the methodology of the study. I took 30 years of data, and I looked at monthly data for the past 30 years. So I looked at the data on a monthly basis. I looked at asset classes that we used, we used indices, basic indexes for asset classes, and then I looked at sectors, and I tried to understand sectors. And we looked at periods of high, medium, and low inflation, as well as periods of rising and falling inflation. Now we focused on annualized forward 6-month return. In other words, inflation is rising today, what type of return am I going to get in the next 6 months? We didn't look at 12 months or 3 years. The reason is because eventually it works its way out. So you want to think about inflation and you want to make your moves in the first couple of months. We considered winners and losers in low, rising, and falling inflation environments. And then we're comparing asset classes to their own average past return and also to the past return of stocks. So here we have the outcome of this research. In a low inflation environment, the winners are real estate, stocks, and commodities. The losers are bonds and gold. Right? Now the next one, if you think that inflation is going to fall, then you want to own real estate and stocks. You don't want to own gold and commodities. And finally, if you think that inflation is going to rise, you want to own commodities and gold, and you don't want to own bonds. Okay, let's talk about this for a little bit, because this is an important thing for your own asset allocation and also for what we're doing with AWS. So there's a few things to think about. First of all, if you see a rising inflation environment leads to commodities and gold, that doesn't mean you should go and put all your money in commodities and gold. Just a portion of your portfolio should be in that. In AWS, the maximum that we would have in commodities, the maximum that we would have in gold is 25, 30% maximum. We're still going to have equity. We're still going to have other aspects. Because why would we own bonds in a rising inflation environment? Because we don't know that it's going to rise for sure. We have an idea. We can't know. This is looking at in the past, remember? Let me have a glass of water. So, next, the question that somebody asked me, and you may be typing this in and asking a question right now, and I'm going to ask the organizers here at Phenomena, are we getting questions? We got some good questions. Hopefully we got some coming in. So, somebody asked me this question, Andrew, why is real estate a loser, right? Or a winner in falling inflation? I thought that it should benefit in an inflation environment. Well, the answer to this is that in the stock market, real estate is not land. Raw land tends to rise with inflation. So if we looked at raw land, you would see that they would be benefiting or a winner in rising inflation environment. But most of the real estate that you're investing in the stock market are REITs, real estate investment trusts. And what are REITs? REITs are basically contractual agreements between tenants of a building and the owners of that building. And those contracts don't get renegotiated that easily. So if you're in a rising interest rate environment, it's hard for the landlords to raise the rent in that case. But if you're a consumer company, let's just say, you can increase the prices of your product just like that. And so the difference here is that in a rising inflation environment, you would probably prefer raw land, but not necessarily REITs. All right, so what have you learned in this section? Well, first, rising inflation winners are commodities and gold. Low inflation winners are real estate. Remember, that's mainly real estate investment trusts, stocks, and commodities. Why is real estate a winner in a low inflation environment? Because the fact is that when inflation starts to fall, also landlords they don't go and reduce the rates that you're paying, let's say. So they can hold the position on the rents in a falling environment. And falling inflation is real estate and stocks. We expect rising inflation, and therefore we have some allocation to commodities. All right, let's look at the outlook for 2021. So another question came in, which asset classes and regions should we overweight? Well, I'm not exactly sure. I think the best way to do it is look at the weighting that I have. So here you can see that my allocation is 65% equity, 25% commodities, 5% bonds, and 5% gold. Now I know that people say to me, why do you have such a small amount of gold in your portfolio right now? But the problem that I can see right now is that inflation hasn't really become as big of a problem as I think it will be. And when that happens, then I think that gold will start to rise. All right, next question. How confident are you with the recent recommendation of 25% commodity allocation, and for how long? Well, truthfully, if you feel confident about your investment strategy and what you're doing, I would say you may be a little bit foolish, because the reality is that it's hard to feel confident on any investment strategy. You always got to be questioning it and kind of second guessing to try to understand, where could I go wrong in this strategy? So if you ask me how confident I am, well, I'm moderately confident. I'm confident enough that I'm willing to allocate to it. The next question that came in was, how long will you keep the commodity portion in the port? Well, basically, commodities should be good in the current environment. And since we reconsider the allocation roughly every 3 months, that's the shortest time frame that I'm going to look at and that I need to be comfortable. I need to let that asset allocation that I've come up with, I need to let it grow. Given the model we have developed for AWS, our research and our views of rising inflation, commodities should be a good allocation. And we'll review that again in about 1.5 months. We reviewed it previously about 1.5 months ago. All right, somebody asked this specific question, why did you select SCB comp for commodity rather than increase in principal GCF? This is a very specific question, but basically the point is commodity funds are a little smaller in Thailand. So we wanted to spread across some different funds because we don't want to put too much in any one fund. That's different from an equity fund, right? An equity fund could be huge in Thailand or anywhere in the world, but commodity funds tend to be smaller. So we just need to spread that risk a little bit. Now another person asked, do you think the current NAV of principal GCF still makes it worthwhile to build up a larger position? Well, be careful about following. This is a very important part something very important that I want to tell you. And what I want to tell you here is be careful about following part of the AWS strategy. Because I look at it as a whole. I'm thinking of it as a whole. If you just pull one part out of it, it may not perform that well, but other parts did. And I may have some strategy behind that. So I would say be careful about that. It doesn't always work out that way. All right, next question. Would you consider to reduce the gold portion as gold doesn't seem to be a stable asset? Well, we did reduce it, but we're not going to reduce it below 5%. Gold is insurance and an asset that can do well when others are doing poorly. It's also considered a store of value and protection against inflation. Right now, we're allocating 5% to gold and then a bit more through the commodity allocation. Remember, most commodity funds have an allocation to gold. So you actually have more allocation to gold. But generally, the lowest exposure that will ever go for gold and commodities is probably 5%. We want that insurance. In case we're wrong, that's there. Now, here's the allocations that I've done for the equity portion. The equity portion I've now taken down to 25% in Asia Pacific and 25% in emerging markets and 5% in the US. The key to this diagram is just simply that for the US, I've reduced my weighting. US keeps rising and, it could continue to rise, but I would say there's getting more risk of that. Now, both emerging markets and Asia Pacific ex-Japan funds have high percentage of Chinese stocks. Are you considering that? Well, definitely. We're tilted towards Asia. Our long-term view is that emerging markets are going to outperform the developed markets, that eventually, between currency weakness in US dollar eventually and US falling under the weight of its own debt, I think Asia is very well positioned for the region. So basically, I would say that I'm a pretty big bull on overweighting Asia. Now currently 19% is in China. If we look at the Vanguard Emerging Market ETF, this is the master fund, and this has an allocation of about 41% to China. The Asia ex-Japan is another master fund, which has a current allocation of about 36. So as such, our current allocation to China is about 19%, or about 30% of our equity allocation. I'm comfortable with that. I know that China is volatile, and I know that sometimes it can crash, but I feel like the longer term, there's a lot more opportunity in China. In fact, one of the amazing things about China, from my perspective, is that it keeps listing more and more companies. And the point is that they are building a very, very big and robust stock market. Now, many of the stocks are not valued as expensively as, let's say, US stocks, but they are. So now another said, should we add SCB DJI instead of SCBS S&P 500? Well, S&P is a broad US index. We prefer S&P because it's broader than the Dow Jones or even NASDAQ. NASDAQ is tech heavy and it works sometimes and sometimes it doesn't. Next question, what's your outlook for the rest of 2021? Do you think there'll be a market correction? Well, I'm going to jump through this and just go to a chart. And in that chart, you'll see this. In this chart, you'll see that the EV to EBITDA in the US now is about 18 times. I've never seen it higher than this. So if you ask me if there's a correction coming, just look at this chart and ask yourself. The blue line is the trailing EV to EBITDA. And I would say we may not be heading to a crash right away, but I do think the market is as expensive as I've ever seen it. Now, I did some study on this and I broke the market down into 10 deciles. And the decile all the way to the right says if the market's trading on an EV to EBITDA greater than 12.3 times, whether that's 1 year, 2 years, 3 years, or 5 years, you've had almost no return or negative return. The point is, if you invest when the market's expensive, it's hard to get a lot of return. And that's part of the reason why I have 5% in the US. Right now, the EV to EBITDA is at 17.9. What's your view on commodity oil prices? What are the driving factors? Well, basically, China's strong demand recovery probably is going to drive commodities further. And so again, Asia Pacific is going to benefit from that, emerging markets also. And I'm going to just skip through that and I'm going to go to the next one. You mentioned, because I want to take some of your questions, so I want to just wrap it up. Let me just go, hold on one second. I'm going to shoot ahead because I don't want to waste too much time. What I'm going to do is just highlight, if you want to go look at the all-weather portfolio, just scan that and go to Phenomena and look at it and learn more. If you're already a shareholder in it, thank you very much, and I'm trying to do my best with myself and my team, and you're welcome to ask any questions at any time. So I think maybe we'll take some questions from the audience now, and I'll do my best to try to answer those questions. Let's see. Questions. Questions coming in. All right. Let's look at our first question. Don't you think that AWS is too conservative? I think if you think that AWS is too conservative, then I would say it's probably not for you. You've got a lot of things that you're looking at and you want to invest more aggressively. Invest more aggressively. Nothing wrong with that. And I invest more aggressively in other areas. But the purpose of AWS is to be conservative. So that would be my answer. The second part of that is that your question could get me preparing to create another strategy that's more aggressive. And I'll come back in a month or so with that idea. All right, next question. Let's see what we got. Hi, John Andrew. Waiting for your update on AWS. Wonder about the opportunity in Asia ex-Japan. I think the opportunity in Asia ex-Japan is great. You know, look at most of these countries in Asia did not print a lot of currency. Look at the Thai baht. If the Thai government was to print a huge amount of baht, what would happen to the value of the baht? It would be crushed. It would devalue. We can't do it. And the result is, for many countries around Asia, we don't have a currency crisis, we don't have a government debt crisis, and we have consumers that still want to consume. So I feel positive about Asia and the underlying, demographics. Next question. Can I dollar cost average AWS? Is it appropriate if it rebalances every quarter? I tried to answer this one before, but the answer I would say is I wouldn't think too much. I would just do the dollar cost averaging and let me do the rebalancing. It will come sometimes where you've got to think about your rebalancing, but Phenomena team will help with that. So I would say it's not a big issue. Next question. Inflation has been closely tightening with oil price. How would that change with the rise of renewable? How would this affect AWS allocation in commodities? Well, first of all, it's true that a big portion of commodities is oil. If oil price started to fall, this is very difficult for commodities to outperform. So that's an important part. So if I'm wrong and oil prices start to fall, then I'm going to eventually get out of the commodities. So also, as far as renewables are concerned, they're making great progress, but I don't see that they're making enough progress that they can really reduce the demand for oil. And therefore, I think that oil still has a lot of opportunity. The last thing I would say in relation to renewables is there's a lot of metals and other rare metals that are used in renewables, and that's also in commodities. So you are getting some renewables exposure there. Next question. You've changed from S&P 500 to commodity. Do you think it is the right decision since S&P has reached all-time high while the commodity has not grown that much? Well, I would say that I wish that I could have predicted how high the U.S. market and S&P 500 would have gone. If I could have predicted that, I would have stayed more heavily weighted, right? And so the result of that is that I would also say that at this point, I'm more concerned about the U.S., so I'm not going to chase the U.S. at this point. So next question. What are the reasons behind this change as I'm doing DCA and I would like to increase DCA to invest in? Well, my point is that the US, I may have missed a portion of the US market rise in the last year or so. I missed a portion of that. But just because I missed that portion doesn't mean I'm going to rush in when the market's trading at almost 18 times EV to EBITDA. So from your own perspective, you may be able and willing to take that risk and allocate more to the US, and you may win on that trade. But for the investors in AWS, I want to stay true to it, which is to manage the risk as best that I can. Next question. Do you have a plan to put cryptocurrency in the AWS port? Well, actually, it's not a bad question, and I had a lot of questions about crypto. The problem that we face in Thailand is that there's no mutual funds that we can get exposure to that are like pure crypto. So from ability to execute through phenomena to get crypto exposure, I don't have it. So therefore, the answer to that question is that no, I don't have a plan of adding crypto to AWS because I don't have a way of doing it through phenomena. Now, let's just say that I did have a way of doing it and you individually have a way. We have cryptocurrency exchanges. We have, all kinds of ways that you can invest in cryptocurrency. I would say there's nothing wrong with adding some cryptocurrency, but I would be careful about the way that you do it. In fact, maybe I can show back onto my screen. I got a question about crypto, and I did provide you some answer about this. This was a question about crypto and DeFi. So here's what I said in that answer. Investors can use crypto to get rewarded with high returns, but of course, it's massively risky. So only play with the money that you could lose. Now, based upon our previous research, we saw that crypto should be treated as a separate asset class. And that's the reason why I'm saying, yeah, a little bit of crypto. It offers some risk-return benefits to existing portfolio. And that's why I think that you could put a small amount of your portfolio. But I'm not talking about a lot. I'm saying 1% allocation is already enough to get some of the benefits. The point is, everybody's like, well, why do I want to put 1%? I want to put 50% or 100% of my money in crypto. Yeah, but you don't know whether crypto is going to fly or crash. For the AWS strategy, I don't want to put my investors through that. But with your own money, you may decide to do it. So let's just look at this study. By using a tiny fraction of 1 to 3%, the portfolio risk does not change substantially. Still, we're able to participate in some of that excess return. So stay with the established cryptos if you're going to go into it. Maybe 80% Bitcoin as an example. For liquidity reasons and degree of acceptance, Bitcoin probably wins the main allocation. You may be excited about getting into many of the altcoins, but just be careful. The remainder, let's just say that that the two biggest ones were Ethereum at the time and Ripple. We know that Ripple started to collapse. But here's the performance of an 80-10-10. Now, when I say 80-10-10, I mean 80% Bitcoin, 10% of the next two highest ones, 10% each. And here you can see the red line is the 80-10-10 portfolio, which went up. And even though Ripple collapsed and stayed flat, it has come back. So I would say you can play around a bit with it, and you can actually improve your returns a bit, but I can't do it in the portfolio. Okay, next question. Why are stock markets soaring when the real economy remains weak? Should we wait for the next steep drop before entering into AWS? Are we in a late bull market? If yes, when will this likely to end? Ooh, that's a lot of stuff. So let's look at that first. Why are stock markets soaring? You may have to go back to that because I'll forget all the questions so why are stock markets soaring when the economy? Well, stock market is soaring for many reasons. First reason is that money is so cheap that people are borrowing it and they're using it to invest in the stock market. The second reason is that when you discount, you can come back to the, so the next thing is that when you value any company or stock market, how do we do it in valuation? Well, we do it by discounting future cash flows. In fact, that's what I teach in the Valuation Masterclass. If you want to become a master in valuation, attend the upcoming boot camp that we've got. You can ask for more information later. But the point that I would make is that I would say that the U.S. market, the economy and the market are disconnected, and the market is flying. the economy also is bouncing back, right? Because we were devastated. So that's the reason why some of that. Now, the last thing I would say is that from an AWS perspective, I would say if you're dollar cost averaging or you're allocating a portion of it, remember, I'm doing asset allocation myself. And that asset allocation is me trying to manage for the late bull market. Like you see, my weighting is 5%. So again, what I would say is either you allocate or I allocate, but both of us probably shouldn't allocate. So I would say nothing wrong with letting the AWS strategy work for you, and then you do some of your own allocation. All right, other questions? Let's see, next question. How many different risk levels AWS portfolios are there, and which investors in age, okay, and risk-taking do match? Okay, this is a really good question because I'm not targeting a particular age. For instance, let's say that someone's 20 years old. You're in a stage where you should be exposed to high risk, mainly equity. But let's say someone is, my mom, she's 82, about to be 83. Hi, Mom, happy birthday. And for my mom, she should not be in the AWS strategy because she should be much more conservative, because if she lost her money in a market downturn, she wouldn't have a way of recapturing it. And so that's where there are different risk strategies. I would say that AWS is kind of a moderate risk strategy. So if you're moderate risk, then AWS will work for you. And if you're, let's say, anywhere between the ages of maybe 20 to 50 or 60, AWS will probably work. Once you get to 70 and 80, you got to make sure that you're low risk in the assets that you have. All right, next question. Do you think Bitcoin will make the stock market crash? I don't know. I would say that's just a lot of speculation. But I would say that I don't think it's going to cause the market to crash, but I think the market eventually will crash. It could be Bitcoin that causes it, but it's not that critical from my perspective what causes it. What's critical is that if you think the market's going to crash, to make sure that you're positioned to reduce your weight to the market a bit. All right, next. What do you think will be next after Bitcoin? No idea. I'm going to leave that for you. I know my limits of my knowledge, and I'll leave that for any suggestions in the chat. Next question. Is cryptocurrency? Wow, there's a lot of questions about crypto. Classified as commodities like digital gold, I guess it would be good in a high inflation scenario. Yeah, I would say that people are seeing crypto. Crypto is a separate asset class. I think you can say that now. It's established as a separate asset class. And in theory, it should be good protection against governments printing a lot of money and the like. So generally, my answer is yes, it probably is protection in an inflationary environment. All right, next question. Do you believe in U.S. bubble? Yeah, I believe that the U.S. is in a bubble. When it will pop, I don't know. It could be a month, it could be 6 months, it could be 12 months. But eventually, it's like feeding a drug addict more heroin. And at the beginning of the night, it's fun, but he starts to go through withdrawals at 11 o'clock at night. You give him more, then 2 a.m. he's struggling, then more and more, and eventually you practically kill the guy, right? So the question section's closed now, so I'll just take any last questions and then we'll wrap it up. Are there any last questions that we've got? Given the uncertainty around the bond yield, do you think growth tech stocks will continue to grow? If not, should we switch to value instead, given the infrastructure bill by Joe Biden? I would say I think tech is under some threat. We've already seen the profit margins of tech companies have gone up massively. Can they go much higher? I don't think so. And I think that they are under some political attack and some other attack. You already see many alternative social media outlets starting to be created. And those social media outlets are taking revenue away from big tech. So I would say that we probably are at the end of the big run. If I look at tech, in fact, I was just looking at tech performance over the past year. And I looked at tech in Asia, and tech over the last year was up 100%. Tech over the last year in the US or in the world was up at 60%. So it's a pretty, and then the next question is about value stocks. And I think value stocks have been out of favor for many, many years. And I do believe that having some value stock allocation is good. Now, next question. In your opinion, for the 10-year investment, what's the proper percentage of stock regional diversification among US, Europe, China, Asia, ex-Japan? Well, I would say probably US 40%, Europe maybe 10%, and then the remainder split between China and Asia ex-Japan. That would be my conclusion of that. So, any more questions, or is that the last question? Let's see. Can we invest by ignoring inflation? I think to some extent you can. If you invest, I mean, think about it this way. One of my investments in Thailand is Coffee Works, a coffee company, and the management team and the CEO of that company are working hard to try to fight against inflation. When prices are rising, they're trying to deal with that. And so ultimately, one of the best inflation hedges is investing in business. So I would say, I wouldn't, if you're an investor in business, I wouldn't worry too much about inflation. All right, I think that was our last question. We have any more? Okay, we're out of questions, so I think I'm gonna wrap it up now. And we got another question. Hold on. How could demographic and technology adoption affect inflation in your view? Well, demographics is interesting because remember I talked about the hundreds of millions of Chinese workers that came into the workforce that went from farms to factories, and that depressed wages for years, but that's not the case anymore. China is more expensive now compared to the last 5 or 10 years, significantly. And it's much more expensive than other countries like Vietnam, Bangladesh, even Thailand now. So there is some demographic pressure on wages that I would say. Now the other demographic is the generation, people are getting older now, and basically consumption habits are lower as people get older. And so when we see demographics like Japan and happening in America, as an example, that people are getting older, you do see slowdown in demand, and that sometimes keeps inflation down. All right, next question. What price of gold can we expect in 2021? Well, I don't know. I think that's kind of a guess, but I would say my expectation is that inflation starts to tick up in the next couple of months. We see that it's real, and then gold probably starts to rise. Whether that's in 1 month, 6 months from now, I expect to see gold start to rise. Now, I'm not allocated to it right now, but I think that allocation will come over time. Any other questions? Let's see. We got more. All right. What's your opinion on SPACs? Well, these are instruments where people are raising money and then later investing it. It's an interesting instrument. I mean, one of the things interesting about Thailand compared to the US, people think that the SEC in the US is really tough, but in fact, the SEC in Thailand is much tougher. Why? It seems strange, right? But one of the reasons why is because the US has a policy of kind of what we call laissez-faire, or allowing the market and market participants to play the game. So if somebody can come up with a SPAC and other people are willing to invest in it and they're following it, right? Then basically, that's it. So I would say those are speculative things. The SPACs are, risky. And so I would just be careful with those. That's all the questions that we can answer from the live audience. Now we still have time to go back to any questions left on the presentation, but I think we've pretty much finished that. So I think we've hit pretty much all of the questions that have come in. And if there's more, I'll try my best to try to go through them. So I think that I'm going to close this down by saying I want to thank you all for spending the evening with me. And here I am at Phenomena Studio. I want to thank Phenomena for having me. And I want to thank you for participating in AWS. The objective of AWS is the global, long-term, and diversified. And also, I want to be a person who can try to answer any questions that you may have. So feel free to contact me through Phenomena in any way, and I'll do my best to answer those questions. Have a great evening, a great sleep tonight, and have a great day tomorrow.